Hello and welcome to the webinar. Today's presentation is on the top 5 KPIs for professional services organizations. My name is Brian Stiefkes. I am an industry marketing manager at Sage Intacct, and I am joined today by Dave Hofferberth, Managing Director of Service Performance Insight. A little bit of housekeeping before we get started. Please feel free to type any questions into the chat box to submit them for the presentation. Generally, we try to keep all our questions saved for the end, but if there's anything pressing as we go along, we may interject. Now, there's a lot of people on this call today, so we might not be able to get to all of your questions, but we will try to follow up with you if we're not able to get to that question. We will be sending out a copy of this presentation and a recording, so you have to leave early, that's okay. Or if you want to forward this along to someone else, you can do that as well. And we always ask, please take a few minutes at the end to fill out our survey. For those of you that are not familiar with Sage Intacct, we provide cloud-based financial management solution designed to provide the functional depth organizations need to run their business. Some of the primary areas that set us apart are listed here. Starting in the middle, which is really our core financials that are built on a multi-ledger GL that provide that deep accounting capability and automation that firms need. Along with that is our ability to integrate with other best-in-class systems. Now, this really sets us apart from those all-in-one type suites. What this does is it gives firms the flexibility to use other programs that are critical to their business and maintain that data integrity with their financial system. Of course, all of that is also bolstered by our real-time dashboards. You know, if you think about all that data entry that you do, whether it be timesheets, expenses, all your project information, you really need to get a way to provide that information in real time to those financial leaders that need it so that they can make educated decisions. One additional thing that I did want to mention, we are the only accounting solution recommended by the AICPA. This is an endorsement that really gives our customers that peace of mind, knowing that they're working with the best partner available. Okay, so without further ado, I'm going to go ahead and hand things over to Dave.
Okay, well, thank you very much, Brian, and thanks for forwarding the slide. I'd like to thank everybody for being on the webinar today. I know there's quite a few people on the webinar today. My name's Dave Hofferberth, and I've been an analyst covering the professional services market for over 20 years now with both the Aberdeen Group and with Service Performance Insight, or as we call it, SPI. And for those of you who don't know us, SPI is a globally focused research and consulting firm that specializes in business improvement and transformation for project and services-driven organizations. A little over a decade ago, we developed the professional services maturity model to help service organizations assess, prioritize, and implement their service performance improvement plans. Earlier this year, we published the 2018 Professional Services Maturity Benchmark Report, which was our 11th, and we've just begun surveying for our 12th annual survey. Today, any of the data you see will be that we collected from 184 mid-sized independent professional services providers, such as management and IT consultancies. So, you know, there's a lot of people who probably listen to SPI speak about the maturity benchmark, but I do want to spend a couple minutes discussing it with you. Talk a little bit about the industry dynamics and trends that are impacting organizations like yours, discuss where to start your performance improvement initiative, and then get into those 5 KPIs that we think are critical for your success. And obviously there's an information component to this that, you know, should help you become more efficient, more productive, more profitable. And then I'll summarize in some conclusions and recommendations. We do have a couple poll questions here, which are always exciting to ask because it's important to understand where all of you sit in terms of your performance improvement initiatives. So the first thing I wanted to do was talk about the professional services maturity benchmark. And again, I took this from 184 independent firms with between 30 and 300 employees, which, to be honest with you, is a big portion of the market because there are so many firms with under 300 employees. The first thing is that we built this model on 5 foundational pillars that mirror your organization. The first is leadership, which is which highlights where and how your executives should offer a clear and compelling strategy and provide focus for the organization. The second pillar is client relationships, and it really concentrates on your sales, marketing, and partner relationships. The central pillar in our model is that of human capital alignment, and really that's your people. They're the core asset in any professional services firm, and this pillar is focused on recruiting, hiring, compensation, and retention. And then the fourth pillar is what we call service execution, and this is how you deliver projects and services, from planning to resource management, project management, your delivery methodologies, tools, time and expense capture, and collaboration. This is where you make money in professional services. And then finally, the finance and operations pillar, and that's the management of all financial information such as revenue, margin, billing, and collections. In each of the pillars, we've developed 5 levels of maturity. And from level 1, as you might imagine, where processes are immature, to level 5, where organizations are operating at peak capacity. And hopefully you can see that very few organizations attain level 4 and level 5 in our model. And this chart on the right highlights the finance and operations results from earlier this year. And as you can see, those organizations not operating well scored on a 0 to 100 scale around 10, 11, all the way up to 40. And the best performing firms didn't even score an 80. So really all this means to your organization is no matter how well you're running, you know you can do better than you're doing. So it's the best organizations that focus on performance improvement and how they can keep going up. And so people say, well, that's great. Financial maturity, professional service maturity. I mean, who really cares? Well, you should. And I think this chart highlights just a few of the KPIs in our finance and operations pillar. There's other views of this I show, but generally when we talk to executives, they automatically steer their eyes toward that last row, which is profitability. And as you can see, again, these are, independent professional services firms, so there is no product associated with them per se. They may have some. But you can see those level 1 and level 2 performers, are averaging around, 5 or 6% EBITDA, whereas that top performing tier is over 30%. So again, if you're a for-profit organization, you should look at this and you should understand where your firm fits in and figure out how to improve, because the key with profitability is that's what drives growth. And in professional services, organizations that don't grow at over 10% are falling behind. And, I talk to manufacturing groups occasionally, and if they get 3% growth, they're happy. Well, professional services is different. And so it's important that your organization is always working on growing, making money. And again, we track about 200 key performance indicators. I'm just highlighting a few here. When you get a copy of this, sit down and figure out where you are in all of these. And so when we work with organizations, we have this thing we call get the red out. So we look at every KPI, all 200 of those key performance indicators, and we say, where are you compared to your peers, and where are you compared to all professional services and, architects, engineers, and embedded software and service companies and so forth. So you really look at your peer group. But you can see on this, this is a fictitious company, Consulting RS, you can see areas where they're operating at level 1 versus one area where they're operating at level 5. And the key for your organization is to focus on those areas where you're in the red, because making something better that's already great, that's wonderful. But if you want performance improvement, if you want increased growth, if you want increased profitability, focus on the areas where you're underperforming. So those in the red or maybe in the orange, that's how you'll get to where you want to go. And we like to tell organizations that it's hard to go up one level a year. So it's not like something you can correct overnight on the whole organization. So you have to be patient. it takes dedication from all of the organizations because everyone in your company really does impact most of these key performance indicators, whether they're directly responsible for them or not. And so I did want to show a couple trends that impact these organizations. Again, most of the people on the phone call or on the webinar today, you're representative of these firms. And so some troubling trends that we found in the benchmark we released earlier this year was revenue growth. We like to say 10% is a minimum for you. And as you can see from this chart, that's not happening. Revenue growth has gone down a few points over the past 2 years. Again, we're starting to survey now. Hopefully it'll go back up. New clients, that's such an important benchmark for your organization. We like to see companies like yours get over 30% of the work from new clients because that means you can offer the existing service portfolio, but you can also create new services because they may have different needs than your existing client base. And again, you can see it took a dip last year, and so that is a little concerning. Attrition in professional services is always something we have to look at. Many of you on this call, well, maybe hopefully many of you on this call remember the dot-com era when we had 20, 30, 40% attrition from the workforce, which is terrible in this market. We saw it take a dip down a little, so we're happy about that. But again, if we could get it under 10%, I think everybody benefits because, again, the people are your key asset. And then project margin. It was interesting. We always tell organizations to shoot for 40%, and we've been close a few times, but as you can see last year, these 184 firms really took a dip in their attrition. It's something we have to consider. Like I said, margin is, that's the fuel for your profitability for your organization. So again, we like you to shoot for 40% or so. And again, so today we're talking about financial maturity and trying to improve. But the fact of the matter is it really cuts across all of the departments in your organization. From your executives who offer the direction, decide what services to be offered, where are you going to expand your market, to sales and marketing that build the programs, that look to see who are the best clients, to create bid prices that meet your margin objectives. And then finally, next, the employees. Do you have the right employees? Do they have the right skills? How much are you paying them? And what kind of training are you doing? Again, focus on keeping those individuals highly trained, highly billable, so that your organization can grow profitably. And then, of course, service delivery. How do you schedule your employees? How do you collect all the information? What kind of margins are you making on the work you do? And how do you invoice for the work you do? Again, the success of your financial organization depends on all of these organizations doing their job to make sure you grow and grow profitably. So I want to switch real quick to one of the 2 poll questions we have and see, this is always interesting for everybody. I think it is. So the first question is, does your company have plans to improve profitability and really in 2019 is what I should have said. And now is the time of year when you should be, considering next year. So we don't have a specific plan. We have early plans, or we're ready to execute right now. Again, one of 3 answers, and it's always interesting to hear what you are doing, especially, where it's almost October, and you should be starting your performance plans for 2019. So again, we'll give it a minute or so, and then somebody's got to show me the results because I can't see them. So Brian, how are we doing on the results?
Yeah, unfortunately, I don't have a view on them either.
Okay.
Maybe if we hit the next slide, we'll get the poll results there.
Okay, let's do that then.
Yep. There we go.
Son of a gun. See, it does work. Well, that's interesting. So this is what I would expect, that many of you are very early in the planning process. Again, it usually is maybe a little September, but definitely October, November. And then, of course, by December, you should be ready to go. So really, it looks I'm pretty impressed with the numbers I see here. Again, I hope that that 13.8% of you that don't have plans, it's something you've got to consider, and the importance of having a plan, especially for revenue and margin, cannot be understated. It is those are two of the most important, eventual KPIs that we see. The organizations that do the best have really good plans in terms of their revenue target and their margin target. So again, it's something you definitely want to focus on. And so just to show what's happened over the past few years, we asked this question of these series of questions for everybody in our annual benchmark survey, just to better understand where they're focused. And what's interesting, for the past 2 years, the number one thing to improve profitability has been improved billable utilization. We'll talk a little bit about that later in this webinar, but you can see that is the most important aspect. And it's interesting, followed by marketing and sales. So again, the push is to get out there in front of the client base, do a great job of marketing, do a great job of selling, and then do a great job of delivering. So usually when we do this, the thing they have the worst time with is increasing billable rates. And you can see, this year and last year, that's what they saw. But a couple years ago, we actually found increasing rates was a little higher. So just something for you to look at and consider in your organization. And so, we're here sitting there. We collect, at SPI, we collect 200 or so key performance indicators. A company like an Intacct, they collect a lot of key performance indicator. And there's no doubt. I mean, there are just so many financial KPIs out there. And the question is, which ones do you go after if you are? And what's so important about having a plan and making sure you understand whatever the KPIs that you are focused on is that you can better understand the trends and make decisions to improve it. So, project margin is one of those. If you see it starting to go down, why is it going down? You should be able to immediately address that so you can improve it going forward. So, again, we're about to do another poll question which might impact that. And the poll question, of course, is how many financial KPIs does your organization track regularly? And I've done this, I asked this question a number of times, and the information that comes out is always interesting to me. So I guess what we'll do is let you complete the survey here and tell us what you do. And I don't want to hit submit. I want to give you guys a minute or so to do your inputting, and then we'll see what we're doing. So, how many financial KPIs do you track? Some don't track any, 1 to 5, 6 to 10, 10 to 15, or over 15. Like I said, at SPI, we track probably 30 or 40 financial KPIs, and then we track, 170 or so other KPIs in terms of overall things. So and this is the results I tend to see a lot. Organizations like yours don't track a lot. We didn't ask which ones. And we think again, maybe we would like you to track over 15 personally, because there's so much insight and analysis your organization can do. But a lot of companies do track less than 10, and hopefully they're the right ones. And if they're not, and you're not getting the information that you need, it's something for you to consider adding some to that. And again, we can discuss that here in a minute. I'll talk a little more about some of the KPIs that we think you should track. So real quick, what I like about professional services is it's some basic how to make money. You have a number of people that bill a certain amount of hours, and they have a bill rate. That's how you make your revenue. Then you pay the labor cost, you pay for overhead, and a few of the other things that usually are part of overhead, and that's how you calculate profit. And how do you make revenue? Well, how do you increase revenue? Well, we offer a number of ways to do that. The first, for instance, is moving to more strategic services. Strategic is a code word for higher bill rates, pretty much, or more hours, basically. Selling longer projects is really important. It levels out the organization so that you don't have people moving from project to project to project and interrupting their utilization or their billable time. Of course, utilization is one of the core KPIs. We'll talk about it later. And then capturing all the costs. And so, bill rates, how do you increase, find better people and sell more strategic services to those people? We like something called service packages because that's where you bundle your services and you're really good at it, so you know what they cost, and therefore you can charge a certain fee and make a much higher margin with them. On the labor side, or on the cost side, of course, on the cost side, how do you reduce your fixed cost? You staff with high margin resources. So it's one of the interesting things in professional services. You have smart people that charge a lot. Well, sometimes you staff projects with a few of those people and then a few lower cost resources. Obviously quality is important, but making sure that you make the margin you need on the entire group of individuals. So some low margin, some high margin, and it balances out to whatever you want. And then, of course, overhead. A lot of companies really try to make sure they don't have too much overhead. And one of the problems with having high levels of overhead is there's higher levels of bureaucracy, and getting things done is more difficult. And as a result, obviously profitability suffers. So again, it's basic stuff on how to make profit in professional services. And you follow the money. Again, you have employees, you're recruiting, you're training, you're compensating them, and then you have project costs, what you're billing and the travel costs, any materials they may need to do this, and then you've got selling, general, and administrative costs, as you all know, and those come in, and those are how you're spending your money. And then the way you make money is you bill. Yeah, and of course, things that hurt you, are days sales outstanding, when your clients, don't pay on time, because that increases your borrowing costs, which ultimately, of course, impacts profitability. Rejected invoices happens a lot more than you would think, because you just didn't prepare the invoice the right way. You didn't put all the costs in. You put too much in. There's a zillion reasons why invoices are rejected. And if an invoice is rejected, guess what? It's probably another 30 days before you get paid. And then, of course, client payment policies. And it's real important for your organization to understand who your good clients are that pay quickly and those that take a lot longer, because you can adjust your fees to compensate for those things. So again, it should be an easy process for your organization. You plan, execute, and complete work, and you capture all the costs. You do it every day probably. You invoice them. You create and review the invoice, make sure it's right, you send it to the client, and then you collect money maybe 30, 45 days later and account for it. It's a wonderful process. We've done this, a million times. Your organizations are good at this. But the problem is, it's never that simple. The first thing we find in professional services is work is completed late. That's one of the areas we're always worried about with any company we work with. If you complete the work late, the invoices go out late. Okay, the work done is wrong. There are so many disconnects between what clients want and what you think you're supposed to deliver. And so we see something called scope change, which everybody on the call knows what that is. And you end up writing off time. You write off hours. So again, the clarity in doing the work and making sure everybody understands what you're going to do is critical. And invoices are either incomplete or they're just wrong. And regardless, they cut into your profitability. If they're incomplete, that means you didn't bill for things you should have. And it's hard to go back 6 months later and say, oh, I forgot to bill you this, $50,000. You pretty much eat it every time. And so making sure you've captured all the work and making sure it's clear to the client what they're paying for. Because if not, payments are slow, and again, your days sales outstanding increases. So when we work with companies and we look at those KPIs that we think you should work on, there are 5 of them that we really like, and they're highly correlated with high growth, high profitability companies. The first is billable utilization. Basically how many hours out of 2,000 we like to use do your employees bill, and we like 75% of the billable hours, so about 1,500 a year to make sure that you're making money. Project overrun, again, that's where the costs come in. Really, companies that use standard methodologies can be more successful in terms of limiting that. Then you have project margins. Again, make sure you have the right resources at the right cost, and you're not eating work because you did the wrong work because the client expected one thing and you did something else. And then, of course, that comes into two that we think are very important, and that's revenue per billable employee. That's your consultant. That tells how well you're delivering services. And then revenue per employee, that correlates highly with how well you're running your organization. And so what do you do, to do that? So I want to get into the next 5 slides to cover this a little. The first, as we said, was increase billable utilization. We like you to shoot for over 75%, or in other words, on average, your consultants should bill 1,500 hours a year. Senior level consultants tend to bill less. Junior level consultants tend to bill a lot more. And what we see from the companies that are over 75%, and again, it's about a 60-40 split, you can see much higher growth rates, fewer non-billable hours, more revenue per project, and everything else. And again, at the bottom, you see much higher EBITDA, and that's what you're shooting for. Again, most consulting organizations realize billable utilization is one of the most important key performance indicators they track, and I expect most of you would track it too. So, but how do you do that? Well, you optimize scheduling. You make sure that you've got the right numbers of people so that you don't have a lot of people sitting on the bench so they're not billing. Using structured or standardized delivery methodologies so that you understand when a project should start, when it should end, how many hours it should take on each task. Therefore, it's just much better to plan, your people's time and effort. And again, you try to reduce the variance of time. So if this specific task should take 20 man-hours, make sure it's not 30 man-hours. And again, and that's how you make sure, maybe when you have a better structure to the thing. So, in other words, there's a lot of ways on the right here you can see how companies like yours can increase billable utilization. And I would take every one of these and think of how you can do a better job of it. The second is project overrun. We want you to minimize it. And again, it's hard. Projects are delivered late a lot of times, and the project overrun happens. What we ask is that you try to keep it under 5%. And you can see that from the survey last year, almost 60% of the companies had it over 5%. Well, when you see those that are not doing a good job, again, it's the same old, same old. They're writing a lot more work off. They're forgetting to bill things, so they have much higher revenue leakage. They have to give greater discounts. Again, a discount basically says, I don't want that margin. But sometimes you have to do that, especially if you're not efficient and you're not delivering on time, on budget. Your clients are maybe take a step back, and what that means is you're going to have to discount more than not. In professional services, not a lot of projects get canceled. But again, if you're not running them well, there's a good chance they could get canceled. And so, the best run firms really get work done on time and on budget, minimizing this. And again, some of the same things in utilization. Using a consistent delivery methodology, limiting scope creep. Projects will change. There's no doubt about it. But make sure that when the client wants the project to change, maybe longer because they want more things, or maybe shorter, make sure you do a really detailed analysis of the change so that it doesn't impact your financial position. So you're not giving the work away for free, basically, and you're not, you're making the margins you need to do. So again, several things you can do. But again, it has to do with a lot with managing the project itself and making sure you're on time and on budget. The third area is project margin. Again, this is the profit. This is the money you make that ultimately will go into your profit, once all the other costs are taken out. And so I showed the slide very early in this webinar that a lot of firms weren't on average making 40%. But it is definitely doable, and as you can see from the results here, a third of the companies had over 40% margin. So it is doable. You can do it. And the organizations that have high margin, they tend to be better run. They grow faster. They're selling more new services to clients. Again, obviously a higher backlog in the organization. And again, more revenue per billable consultant, more revenue per employee. So they're running projects better, making more money, and the organization is running better because they have higher, revenue per consultant and, employee. And again, a lot of this comes down to how do you plan, schedule, and deliver the work, and making sure that you account for all of the financial information and all the time required to do it. It isn't an easy thing to do, believe me. People start working and start billing, and maybe they don't include some time here or some time there, or they forget a cost here, a cost. It's tough, and so you shoot for 40%, and hopefully you can attain it. We see companies with 60% project margins, so it's doable. But there are a lot more planning up front for you to be successful here. And then maximizing annual revenue per billable employee. Again, this tells how effective you are at delivering services. What this really means is your employees are moving from project to project, minimizing downtime, bench time, and they're just getting a lot more work done. Maybe they've charging more money per hour than maybe the others. But you can see only about 20% on this chart averaged over $230,000 per consultant. We like higher numbers than that, but for IT consultants and management consultants, we try for a little higher than that, but still pretty good numbers. But you can see that those organizations that do that, they also, of course, as you might imagine, have higher revenue per employee, and they grow faster, and all of those things. I mean, again, you have to keep people highly utilized to achieve revenue per billable employee of those levels. But the point is, look at the difference between those over $230,000 a year and those under $230,000. I mean, on a relative basis, they are very different. And so, again, when you're doing your planning, looking at all of the information, looking at your clients, what are you selling? What are the costs? What are the margins? You want to focus on making sure your employees are billing a lot of hours, and you'll achieve those levels. And then finally, of course, annual revenue per employee. Again, this is for the whole company. And it has similar numbers in terms of about 20% or so had over $190,000. And it just reminded me, if I look at our entire benchmark, we usually try 200 for consultants and 170 for employees. So what this means is we use higher numbers for independent firms because, again, you're just directly selling services. There's not a hardware or software component that you have to that might get in the way of you being able to deliver. So, we like higher numbers here. You can see that there are higher numbers here. And so, again, it's the same story. I don't have to go through every line item on this. I think the only thing I need to go through is the delta, the difference between those that are over 190 and those under 190. And you can see that they just are operating at so much higher of a level. And so it's not that one gets you the other. Like I said before, your entire company is interconnected, and everyone in the company, virtually everyone in the company, impacts a lot of this. So if you're doing a great job of selling, you're going to make more money per employee, per consultant. If you're not, you're not. But likewise, if you're not hiring the right people with the right skills, then you're not selling the right services. So again, when you look at your organization and a lot of the KPIs or the metrics, it's important to understand that those metrics impact other organizations besides the one that they may be in. And so, again, we want you to focus on improving financial maturity, from going from the less mature to the more mature. And again, what we see is, and I've been doing this a long time, those less mature, they operate on spreadsheets, they collect the information that way. It's not, it's not phenomenal, it's not as organized, but you can do well living on that, but it just doesn't happen as much. And so, as companies grow, they realize they need some grounded solution to manage their finances. And so they start bringing in accounting solutions to collect a lot of the financial data. And then little by little, they stabilize it. They figure out what they're doing well. They do a better job of managing money, cash flow, and so forth. Better understanding of where they are in terms of margins. And it could be by client, it could be by specific service delivered, it could be by consultant. Again, a little slicing, a little dicing of that information. And then as they get more mature, they tend to integrate. And if you've ever heard me speak, I probably have never given a speech in 20 plus years that I didn't use the word integrate. Because again, the success of your organization it requires the success of every department in your company. And so the integration of your solutions helps people responsible for human capital, helps them better understand what's selling, how much it's selling for, therefore who should they really be out recruiting. What are they selling? That tells the consultants, here's the skill sets we need, here's what we should charge, how do we staff? So again, as companies like yours get into level 4, level 5 maturity, you're really taking advantage of the information. And I think what's real interesting, and this is really not a long-term thing, the cloud really did change a lot in professional services. It really helped get the information out to the field. And again, you have consultants who maybe work 80% of their hours off-site, and having that information that just wasn't easily available a decade ago, sitting in their fingertips so they can understand and look at the KPIs to understand where or what they need to do next to make sure they're making their numbers and the overall organization is doing well. So again, real important stuff, and it, like I said, it takes about a year to go from level 1 to level 2 and so forth and so on. So it's not easy, but I know you can do it. So with that, I really want to thank you for listening. A lot of people on the call, but everybody likes to make money, so I'm all for that. So good luck, and now I'd like to pass it back to Brian. All righty? Thank you.
Thanks, Dave. You ended a little bit early. We could have done the top 6 KPIs for professional services firms. Good stuff, everybody. I know there's a lot of questions out there. Just hang tight. We will get to those in just a minute. Before we do, I do want to fill you in a little bit more on Sage Intacct Solutions. This diagram really just kind of helps illustrate how you can put together the right solution for your business, and focusing obviously on that general ledger, on that core financial functionality that you need that includes things like reports and dashboards and order management, payables and purchasing. But then expanding that. So this is where you start to get into that situation where you can make sure you're building a system that works for your needs. And that includes things like time and expense management, project and resource management, revenue management, even those of you that may have some type of subscription component to your contracts or your billing. So Sage Intacct really has a lot of flexibility when it comes to providing the right solution for your business, which is really critical when it comes to getting those measurables back out like Dave's been talking about. And I wanted to spend a little bit of time just to highlight some of the different components of our software. So if you think about it in terms of dashboards, right, I mentioned that earlier, of providing that information back out to your users. You're getting all these timesheets, you're getting these expenses, you're billing your customers, you've got work in progress, making sure that at a glance, people like your CFO or your controller, whoever it may be, can grab that information in real time. So whether it be revenue, is it up, is it down, the expenses, where are you at, EBITDA, all those different things presented right there, because if you're not able to measure, if you're not able to see it in real time, it's very difficult to be able to affect those numbers to see those different improvements. So it really starts with being able to measure and, of course, being able to drill down into that detail as needed. Getting into some operational dashboards, things that were mentioned earlier, utilization right there, big deal for professional services firms, being able to stick that right on top of a dashboard so you can see that in real time. Of course, profit margin on this dashboard, something that you don't want to see, that red arrow pointing down, but it's critical information to have if that happens to be the case. Calling out those boxes, making sure that they're just easy to consume so they're not buried within multiple reports. And I think that's the thing that a lot of people are trying to get away from. You don't want to be in a situation where you got to pull this report, 5 different reports in order to try to get certain blocks of information out. You want that information to be really called out. And then, of course, being able to access the details so you can do your own reconciliation or making sure that you can dive deep into what's going on with the information that you're seeing. This is all provided within the Intacct dashboards. And, of course, those frontline managers, you think about those people that are on the ground. Are you arming them with the right financial information that's easy for them to consume so they can make the right decisions for their projects? You talk about some of that scope creep, some of those things where the customers are asking for more and more and more. You want to make sure that your project managers know exactly what's going on with the job so that they can make the right decision on that. And, of course, as Dave mentioned, that resource management component. Do you have the right people on the job at the right billable rates? So if you can start to migrate some of that high-cost work maybe down to some of those lower-cost employees, having the visibility and the tools in place to see if you can do that on the job is critical. You want to have alerts, anything that you can have to make sure that your team is armed with what they need to be successful. So I want to talk a little bit more about that best-in-class integration. And again, I mentioned this before on how we differentiate from some of those all-in-one suites. There's a lot of vendors out there that like to promote themselves as an all-in-one solution. But really what it is it's, multiple software systems that have been acquired over the years, duct taped together, and then presented back as a single solution. And what a lot of firms find is when they go with a solution like that, they're having to change their own business processes to match what their software program can do. And really what we want to do is we want to provide an arena where there is a best-in-class solution. You can choose the solutions that make sense for your business, how you run things. And that way, your software is working for you and not the other way around. But don't take our word for it. So success by the numbers, and we've got a ton of these. And these are our customers that are saving time when it comes to manual processes that they used to do, whether it be 500 hours annually through automation or cutting out a week of extra data entry, cutting 16 hours per month for CTI, 16 to 22 hours per month. I mean, story after story of our customers that are able to build automations, use our deep accounting functionality in order to make their daily lives better, but also create a situation where instead of doing all this administrative work trying to get the data right, you're able to look at the data and spend that time actually analyzing it so that you can decide how are you going to improve those various benchmarks to improve where you're at on those KPIs. Again, we are committed to customer success. We are the only preferred provider from the AICPA. I've talked to a number of our customers. That was just a very, very critical piece to their buying decision. They wanted to feel comfortable in making that decision and making that commitment to a new accounting software. So the AICPA endorsement was a very, very big deal. For Gartner, since Go, we've been one of their visionaries for cloud financial management. We are a platinum partner for Salesforce. And finally, one of my favorite ones here is the G2 Crowd #1 in customer satisfaction. It doesn't get any better than that. If your customers are willing to go out there and speak your praises about how great your software is, how great your support is, that goes a long way for helping people that want to make that decision, that want to find a system that's better to help them solve their different needs. So definitely encourage everybody to join us for what we like to call coffee break demos. These are 30-minute demos plus some live Q&A. It's a great opportunity for you to just kind of sit back, have your morning coffee, and see what our software can do. You can register at the link that's shown there. When we send out this deck, you can just click on that link and get all registered for our coffee break demo. And with that, we're going to go ahead and open things up for questions. Okay. Dave, let me pull some good questions for you.
Okey-doke.
All right, so the first one we got here, if you're limiting the bench to ensure a higher average utilization, is there a recommended strategy to scale quickly if sizable engagements are on the horizon?
Oh, that's an interesting question.
Yeah.
The one thing I didn't discuss here was, and this is something that we do ask in our survey, is your use of third-party resources. We'll just call them your partners, and that's an important resource for you to have. In general, when we survey, about 10 to 15% of your work is delivered through your partners. And what makes it great is that you can scale up or scale down as the work comes and goes. And again, if you're a partner of one of your partners, they realize this. They realize that, hey, they're going to call us when there's a lot of work, and they're not going to call us when there's not much work. That's okay. So the best firms really utilize that third-party resource to scale up or scale down. Again, I'm not saying cut your firm down to zero bench time. What we tend to see is organizations where utilization might fluctuate 10 or so percent. So in other words, maybe your average is 70% billable utilization. It goes down to maybe 65% for your employees when they just don't have the work in or something's going on, and it may shoot up to 80% when too much work is coming in. And it's real important. Again, utilization is such an important KPI because if your employees are all of a sudden utilized 80, 90, 100% of the hours or more, we use a 2,000-hour work year, but when they're overused, they burn out. When they're underused, they get frustrated and quit. So it's something you really have to monitor, and that's why it's such an important KPI to make sure that they're all kind of working within the same range. And if again your goal is 75%, and you're shooting for 70 to 80% on average from a week-to-week basis, and then you're utilizing a third-party resources. And there's a lot of independents out there that like being third-party resources. They don't want to work for a company. They just want to come in and do a project and then take time off because they've got other things they want to do. So real important to do that.
Good stuff.
Ryan?
So thoughts on KPIs, and this is an interesting question here. So thoughts on KPIs for organizations that bill on a contingency basis or success basis versus the more traditional dollar per hour?
Boy, that is interesting. And we do have, it's probably less than 5%. I can't remember the exact numbers. 5% of the organization we survey do that. It is interesting. Again, we went from an era where most of the work was time and materials. Then it transitioned to fixed price. And again, great firms did well there. And now all of a sudden there is a movement. I wouldn't say it's a significant movement, but a movement, to success or to value add. And it could be risky and dangerous, but it also could be very lucrative for your firm. So you share in the success. Again, if that's what you're going to do, you need your processes really well laid out. You need, again, that's why they use more structured or standardized delivery methodologies, so that at every phase of the project, the organization, is adding value, and ultimately, the project ends up adding significant value. So it's an interesting. We just don't see a lot of it, but again, if you want to take the chance, you can make a lot of money that way.
Yeah, good stuff. So here's another question, and this is related to time entry, and I've actually got some input on this as well, Dave. So what's the most effective time entry cadence to get accurate time recording? And the person asks, is it daily, weekly, or other? And I can tell you from my experience, you want to get as close to daily as possible. Any time you get removed from actually doing that work, the memory starts to get hazy. I mean, the moment you move on to your next task, your memory starts to get hazy in terms of what it was that you did, how much time you spent doing it. And it's not just important for the timesheet to be correct, but also if you're doing daily timesheet entry and you've got the right system in place, your project manager is able to see that instantly. So again, going back to that ability for a project manager to be more financially minded when making decisions about projects or future resource scheduling, or when it comes time to review invoices. They want to have that most current and up-to-date information, so as close to daily as you can get. And as you can imagine, the further out you get from the time that it's incurred, the more margin for error you'll see. You'll see 5, 10, 15% timesheet errors start to creep in there. Dave, do you have anything to add on timesheet?
Yeah, no, I couldn't agree with you more. I've been doing a timesheet now for over 20 years, and when I forget to do it, the next day is difficult for me to remember. Okay, when did I work from when to when? I mean, again, like you said, if you're entering it on a daily basis, the manager, maybe tomorrow morning, again, has access to it so, he or she can see how successful the project is, is something going wrong? That's, when things are going right, everybody's happy, but, what you worry about is too many hours on a specific task or something, and all of a sudden you realize this project is not going in the direction it should have been going. And again, that's when project margin goes down, and it's also when client satisfaction goes down, because they can see you're not getting the work done on time, on budget, and then they start to worry that will they ever get it done on time and on budget. So again, entering that information every day gives everyone who needs to have that information has visibility into it to make sure that they can make modifications if something is not working the way they want to.
And there's a lot of different thoughts on there on achieving daily. Is it the carrot or the stick? Do you incentivize people for daily time entry, or do you threaten to withhold paychecks if they don't have them in on time? And really, it can depend on the day of the week or the controller that you ask or whoever's in charge of it in terms of what answer you get. But I've generally found that incentivizing employees to do it. I've seen people have quarterly company picnics or trips that may depend on achieving a mark like daily time entry. But you got to also try to get this enforced top down. And I know a collective eye roll when I say that. The principals and project managers generally can be the worst offenders when it comes to some of this stuff. But if you can get that top down buy-in and show those principal level people like, hey, look, timesheet errors are costing us, and this is a dollar for dollar cost. Every time it's an error or missed time entry, that's just revenue not billed. So it's really, really critical to get that buy-in. And Dave, to further on what you're talking about in terms of project managers being able to see real-time utilization and real-time cost, how does that come into play for an employee that may be working beyond 40 hours in a week in terms of those maybe being billable hours? Are you looking at utilization as, say, 100% of the person's time and then, dividing that out into percentages, or is it the effective cost of, say, this person was able to be billable for 45 hours and we're only paying them for 40 hours of work, and then you recalculate that cost to the project? How do you look at that in general? What do you think is the best practice?
Yeah, well, again, and we survey over 400 firms a year, and trust me, there are probably 200 ways of doing that. So, we like to use the 2,000 hour a year number. In Europe, a lot of firms don't work that many hours, and in the U.S., basically that means 50 weeks times 40 hours a week. But what happens is, and we see this all the time, we really are interested in, and the reason we're interested in the 2,000 hour, because that's kind of normal for the year. And so we do see a lot of individuals, especially more junior level consultants, that are over 100%. I mean, again, you see it in law firms, you see it in consultancies where the employees are working 60, 70, 80 hours a week. Obviously, you can't do that forever, or the burnout, comes into play. But we do have a lot of firms that they actually, and we want to count every hour. I mean, if you're doing a billable hour, that goes towards your billable utilization. I mean, it's not fair to stop at 40 hours a week. And this week you may work 50 billable hours. Next week you may only work 20 billable hours. So again, over the course of a quarter and a year, we can see that. And also what's important is monitoring the trend. Again, if we see the trend going down on billable utilization, does that mean we're not selling enough work? Does that mean we have too many people? I mean, there's a whole host of things that you should analyze if utilization is starting to suffer. Likewise, if it's getting too high, maybe you need more third-party resources, maybe you need more hiring, maybe you need more training, to get the right people going. Because again, we throw this term utilization out. Well, that's great. You may have 5 or 10 or 15 different skill sets in your organization, and one skill set is 90% utilized, and one of the other skill sets is 20% utilized. So again, you have to look at that across the entire organization, and the key is slicing and dicing, in a variety of ways, by skill type, by client, by geography, all of these different ways, because the better information you have, and again, some kind of analyst within your organization that's really looking at this, they can figure out where you're not doing well. And again, focus on getting the red out. Where are you not doing well, and figure out ways. Maybe it's additional training. Maybe you just realize that this skill set is not going to be required going forward, and you do them a favor by getting rid of them, and do them a favor so they can go out and find somebody that wants their skill set. So again, always looking at billable utilization, because it's such an important KPI.
Yeah, good stuff. And that's something that I've always believed in as well, is having that standard cost versus the effective cost. It helps keep things level as well. So you don't want that variability, after you run a payroll period, to suddenly change the costs that affect your project. I feel like it ends up giving you sort of a warped view a little bit in terms of how you've actually performed, because that employee's billable utilization might have been somewhere else. So it's good to keep it at a standard cost if you can. Obviously, every business is a little bit different. And of course, one thing to keep in mind is you'll end up with a payroll variance line item that you have to use to keep everything nice and reconciled when you do that. But it's the only way to really get real-time data, is to use that standard cost and standard utilization.
Sure.
Okay, moving on. Another question here we've got, can you elaborate more on the difference between revenue per employee versus revenue per billable employee?
Yeah, sure. Believe me, when we do the survey every year, sometimes some of the companies we work with have a problem. It's just, well, first of all, the hardest thing is, revenue per billable employee, because, that is obviously every employee that's a consultant that bills. Now, the problem comes in when you have people that might do a little billing. Some consultants, especially at higher levels, may only bill 100 hours a year. But guess what? They're running the firm. They're running the practices. They're running the clients. But they still count as a billable employee. And so all the people that have actually written their time down or a cost down to bill an employee, that's where the billable employees come into. Everyone else in the company, that's your administrative and support staff, that probably is going to be your sales and marketing people, and sometimes in consulting, consultants sell, but a lot of times in bigger firms they do have dedicated resources to do marketing and sales and HR and all the back office and legal. Those employees don't bill. And generally, and I don't have that number sitting me, unfortunately, it should be staring me in the face, but it's usually around 75% of the employees are billable, 25% are not. So again, therefore, obviously, revenue per billable consultant is higher than revenue per employee, because it's just a bigger denominator. So, you bill, $10 million. Well, 10 million divided by 100 consultants, or 10 million divided by 130 people. Obviously, it's going to be less, unless you're a firm with 0 administrative people. And smaller firms sometimes don't have administrative personnel.
Great. So Dave, you've been doing this for a really, really long time. Sorry to do that to you. But just kind of curious your take on, the advent of software programs, of accounting programs that are able to collect this data and present it back through those dashboards like what I had shown earlier. What's your take on the ability for firm leaders to make improvements to these KPIs by being armed with these new systems?
Oh, I mean, it is. The world has changed, especially in professional services. 20 years ago when I started, and at Aberdeen, they asked me to start looking at this market. I mean, a lot of the firms didn't use much. Not a lot of the professional services firms, they sold it but didn't use it. It has changed definitely since day one of my doing this. But again, like I said a little earlier, I think what really changed the market for the better was the advent of the cloud-based solutions, because now all of a sudden you should have access to real-time data. And again, like you and I just discussed, people need to input their time and expenses every day, because that real-time data and the dashboards that now have been created, help any executive or any project manager or program manager or any line manager run their business. So regardless of the role, and also consultants, your consultants should have their own dashboards so that they can look and say, okay, gosh, my utilization's starting to go down, or this cost is starting to go up, or I've got these 5 projects and I'm behind on 2 of them. I mean, everyone needs that, the dashboard view, because that's what's really going to help them streamline what they need to do next to make sure they're on time. And so, it's wonderful the change in this market, over the past few years, because now, from like Intacct, they've got the tools out there to let people see how they're doing, and really it's not to see how you're doing, it's see how you can do it better, how you can improve performance. That's what we're always focused on, and again, without the information, how do you know where you really need to improve? So, it's just a great market now, and real exciting to see what's happening.
All right, Dave, thank you very much. And we have reached the time limit of our webinar today. I want to thank everyone for joining us. Dave, thank you for presenting. For those of you that did ask a question that we didn't get to, we will follow up with you to make sure we get that question answered. Dave, you got any parting words for our audience?
No, I guess thanking everyone for listening today. The questions you guys asked were really good. Again, it's time to start planning for 2019 and seriously sitting down and assessing what KPIs your firm needs to track to make sure you're going to have a great 2019. So best of luck to everybody, and hopefully we'll see you soon then.
All right. Thank you, everybody, and this concludes our webinar. Have a good day.